I think what is the most positive thing about the JP Morgan earnings is that they were better than expected and reassuring. So what we've worried about the most as a market is that we'll be heading into a recession. Interest rates being higher, we've sort of put that to rest right now since the Fed spoke. But then there's been fear that there'll be a recession. We know earnings are weak for this quarter, maybe next quarter. JP Morgan had good earnings. The bank sector is likely to have reasonably good earnings. And so if we don't have to worry about that right now, I think investors are more comfortable buying into the market. And this is one of the sectors that has been underperforming dramatically. It's up 11%. Technology is up 23%. Year to date. And so that makes people feel better. And it's a good way to start earnings season.
I wonder if that's sort of the theme, Rick, playing out right now in the bond market as well, sort of moving away from the recession or some recession false alarms.
Well, you know, we could debate as to where the pressure in interest rates came from, and I would debate that global slowing had something to do with it, but more from the standpoint about how that global slowing affected rates outside the U.S. Listen, we could debate all day. Most of the people I deal with never suspected we were going to get into recession mode. As a matter of fact, they traded appropriately, you know, when the stocks were, you know, at bear market territory at the end of last year. That proved to be a wonderful buying signal. Now you're seeing that the equity markets, in my opinion, actually kind of pulled up the last 3 or 4 basis points on the yield curve, and I can't stress how important that is. Now, the cash market isn't closed, but right now, should we close here, 2-year notes are a basis point and a half above that 238 spike low from January 3rd. 10-year is basically at a 4-week high, and 256 is like a half a basis point above its resistance, but cash markets aren't closed. It's going to be a close call. The long and the short of it is that interest rates and stocks are at critical areas, all-time highs, close to it for stocks, breakout material for treasuries. My guess is next week, either they're both going to back off or they're going to zoom through, and if I had to make a bet, I think I'd take the latter.
Kari, it's been a tough week for healthcare. Is that a buying opportunity?
Well, it's an interesting comment because the healthcare sector, as we know, has been the worst of the major sectors. It's up about 6.5%. The market's up almost 17%. But if you were to dive into that, you can see that smaller cap stocks, whether they're biotech or the device companies, veterinary companies, we own a number of healthcare stocks that have done extremely well. It's the big pharma stocks that haven't done well, and some of the big insurers. There's a company we own called Biohaven. It's a biotech stock. Today it's up 21%, or it was when I left my office, on takeover rumors. So there's interest in smaller cap and non-big pharma names, but I don't know if we're going to get this moving. I think we have to see some sign that either the bigger pharma companies can get new drugs approved, or that there's less of a focus on price controls from either party right now.